Hey guys, how's it going? I've got something that isn't a review today. I've had a lot of friends asking me about my setups, as is usually the case for any trading related stuff. It's always the setups. And I had an idea for a video that I wanted to make, so I'm here making this video, and it's on the behavior, the cycles in small caps, and this is mostly going to be adopted from, believe it or not, the stuff that Tim Sykes originally coined in his penny stock cycles. And I'm going to show you how this, like, if you ever heard the concept of how like price action is fractal, I'm going to show you how that is fractal in like day one gappers, because usually when people are referencing Tim Sykes penny stocks patterns, they're referring to like multi-day runners. All right. And I use a pretty similar formula in my day ones. And it's really what helps me feel comfortable with the price action that I see every day. Because even when there are some slight differences, I sort of have this game plan for how I'm gonna approach basically all tickers, and it's based on this idea. So I figured I'd go ahead and give it a shot at like covering this, especially for anybody. I know I've got a lot of my friends who are interested in small caps and they don't really know where to start. They don't understand the differences between the price action small caps and some other things. And at the most fundamental level, small caps really are like a lot of other markets where they're like auction market theory, range bound sort of stuff. It's just so extended, and it occurs sometimes at on such a small time interval that you don't even see it. But I'm going to use Tim Sykes's penny stock cycles to explain what I'm referring to here. And I guess yeah. So I will start with just to give a quick like overview of the way Tim Sykes looks at penny stock patterns. Gonna need a good example ticker here. Like let's see if I can go over to FFIE. I want to grab something really extended. Going over to the daily chart and see if I can pick up some really excellent example. This is okay-ish. I could probably get something even better. What about uh like a multi-day? Serve did some really nice stuff. Well, I guess it was 2 runs though here. So um might as well use serve. Might as well use serve actually. Sure. So the idea of the penny stock life cycle that he has is it starts with some kind of pump. You have stagnant, usually range bound, or in the case of penny stocks, downtrending behavior. And then you have some kind of catalyst, and it catalyzes a move, some kind of pump, and the stock goes up. And the first phase is pretty much just that, where you have a stock that is consistently uptrending for some amount of time. You can have one leg, or you can have multiple legs. And the second part is at some point or another, it gets too euphoric, and we get some kind of major fail near the highs. And people will trade this major fail near the highs as a first red day setup. You can get it multiple times if you have first legs, or if you have multiple legs. But the idea is that the one that's going to set the top is usually the biggest, and it also is preceded by the most euphoric move. So you have this first red day here, and usually there's some continuation as well. And then after this first red day and a few days of continuation, the idea is you get too distended, pushed too far down, and then you have some kind of small bounce, like a dead cat bounce like this, and then you continue going downwards. And this cycle will repeat itself. You'll get too distended downwards, and you'll have like a small bounce, kind of like this. And the idea is you get smaller and smaller as you approach the baseline. So that's the basis of what he really teaches. And there's a lot of like nitty gritty things in there, but the idea is that you follow this general pattern whenever you're trading a small cap, and um, as long as this pattern continues to be shown, you're in decent hands. So I was gonna the reason I had Hoth brought up was because I was gonna use Hoth to explain the intraday case here, and we actually also have a backside here too. Perfect. So, yeah. So, how does this translate to intraday stuff? Now, so to start, we have the same idea with a move on the front side here. And then usually we have some kind of backside move that gets a little bit too aggressive. At some point, we hit a bottom here and we get some sort of reclaim. And then the pattern repeats where we go down and you get this zigzag slowly going down. And this is the general idea. Now, this is really rudimentary in its current state that I've explained it to you so far. And I'm going to get into the little nuances here, but I want to make sure that this general pattern is really clear before I get into the nitty gritties, because if you like get lost along the way and you fail to consider this part, some of the other little things won't make the most sense. So first we got this, and yeah. So analyzing each of the individual sections now, for the front side, because this is the kind of stuff most people like the front side the most. They're the most interested in this first section right here because it presents the biggest leg up. And for the most part, people see these big runs that you sometimes have in penny stocks, and they will be like, oh, this is the move I want to catch. It's the biggest move of the day. The dilemma with this is that, especially on the front side, a lot of the price action you see here is going to be difficult to pre-predict. The number of legs that this kind of stuff puts in can be almost arbitrary at times. So what you have going on here can be quite difficult to capitalize on. And realistically, if you put all your effort into investing yourself into something like this, you'll find that even in best case scenarios, you only capture like a chunk of the move compared to what backside offers, where after this first move, every successive move is going to probably be downwards. Now, the cycle is fractal, so the interesting way to look at this is like if we go on over here to pre-market, we have a similar idea here where you have a move up and then we're expecting some kind of distension down that goes too far, and then we're expecting a move up again, and then we are expecting this to continue lower here. However, that's not really what happens in this case. We end up going higher. And what I want to explain here is what separates the front side from the back side, because this is the most important part to start out. Now you're always expecting for this first leg to be the biggest within a single individual cycle. However, the way you progress after that can change. And the reason why you can get like massive front side moves, as I'll show you in a second, can be somewhat arbitrary here. So the biggest move you have, of course, is the front side move. Then you've got some kind of initial response on the backside. You have a dead cat bounce of some kind. And the idea is that this is going to continue lower. However, what happens sometimes is you don't continue lower here, and instead you go up like this. Now, whether or not you go up or down here, I like to consider it as like almost a 50-50. In reality, it's not. In reality, the odds of us continuing lower are higher usually. Like I'd say, so amongst like the runners that I play that happen after the open, the odds of us continuing higher here are about like 25% here and 75% down here. But this doesn't break the pattern, because the idea is that every successive move upwards just expands the idea sort of to like a higher time frame. So what you end up having is, if you look at a higher time frame, all you see is a leg, then a pullback, then you get another leg higher, and this right here is your 25%, 75% right here. But people want to play this 25% side here, because of survivorship bias. When you see the stuff that makes it to the open, and when you see the stuff that continues after the open, in fact, even, you're basically just stacking 25%ers. Like consider this, like in the case of Hoth, for instance, right? The idea here is, I'm gonna actually screenshot this. to show you what I mean. If you treated this as a percentage basis, that's just a raw percentage basis. This first move down here, it's just, I mean, this is 100%, right? Because this is the start of the runner, right? But then we have a decision that needs to be made whether or not we go up or down here. And the odds of us continuing higher here are 25%. The odds of us going down here is 75%. But people never see this 75%. People never see these, right? Because they only pay attention to the stuff that makes it to the open and goes beyond, right? So by that point, you're playing 25% case. And right, and then we go higher. And then we have some kind of pullback again. We go higher. This is also 25%. This is 75%. And as a result, we have these 25% nested on top of each other, right? So what happens is, let's say you want to play a breakout, right? And you want to play the breakout over here, right? Because looking back in time, you see these moves that do like a whole bunch of legs, right? You're like, oh, so if I play this breakout, right, this is the move I should expect to see. That's not true. You should expect to see it. First of all, you should expect for it to make it to the breakout level 25% of the time. And you should expect to see the move another 25% of the time. So realistically, if you buy the breakout, you're only going to see this 25% of the time. And if you're like buying down here, you're only going to make it to the breakout point 25, or it's going to be 0.25 times 0.25% of the time. It's like 0.06-ish or something like that. So you get like 6% of the time do you see this like big move here. This is like 6% chances of happening on all the tickers that make it to the open even, right? It's a very low number. And I think that's actually about right. I think it's like 10%. I've checked like the runners, like and I short these runners. I think it's like 10% of stuff that makes it to the open will end up doing something like this. So that checks out about right. So it's so playing this like front side for this continuation, these big moves that you see, you need to consider that. You need to consider like the odds of that big move ever happening, like ever manifesting, just from a probability standpoint, right? And it's important to consider every single time you encounter the crossroads, the fact that the down case is more likely than the up case. And in a best case scenario, it's a 50-50. So how do you like play all this stuff to your advantage? All right. Well, first of all, you follow the pattern, and I'll show you how to like, so I'll show you like where you can position yourself for long side, right? So, and short side. So off of the open right here, most of the stuff we're going to see ends up fading. But in the case of the things, the 25% or more or less that end up going up, right? Using Hoth as an example here, we have the leg up again, like I mentioned. We have a leg down. We have some kind of excessive distension, and the idea is we go up, and then we want to see the fade down, but we don't end up getting it. So the idea is, if we're looking for the continuation higher, then we want to see something like this right here break. Because at this point, everyone who's playing the cycle, the penny stock cycle, is going to be caught off guard, because they're all expecting like down, some kind of move up, and for this to be the local high, and for us never to retest this. Or if we do, like, you can consolidate back and forth for a little while, but we don't expect for this to break with some force. And what really usually happens is the way this actually plays out here. Now using the Hoth bigger move, for instance, we've got however many legs up, and then we've got this move down. We'll consider this distended, and I'll explain distension and extension in a second. And then we get this sideways move, and we're expecting some kind of consolidation here between a support and a resistance level. Something like this, all right? And we're expecting for this first move to be, if it is truly distended, we're expecting for this to go beyond the support. and then we're expecting for it to reclaim and get stuck in this range for a little while. And the idea here is that you're always assuming the breakouts are going to fail. So what happens here is we finally get a move higher out through the resistance level, and shorts aren't going to end up stopping out over here because they expect for this whole penny stock cycle to play out, for a distended move down, then some kind of dead cat up, and then they want to short after the dead cat. And the reason it happens is because of this consolidation manner here. So we're going to have shorts probably in this area where the wicks are, and they'll short it back into the range, and they're expecting now the range to break to the downside like this. So the cases where this doesn't work out are cases where we get all these wicks, maybe we tap the top side, and then we'll continue rotating higher. And that's what you see over here on Hoth, where we have a resistance, we have a support, not a lot of distension, but the idea is the same. Get the move up, the move down, and now we're expecting some kind of move to the upside that eventually extends too much. This one ends up going above the high a day here, and shorts are going to pile on over here because they're like, this is the biggest move for the local high, and they see this going down. They're like, oh, it's going to go down into the range, it's going to break to lows, right? But that doesn't happen. We end up going down here, and when we break higher, when we break this candle high here, now this is where shorts are stopping out because the entire cycle has been broken. You can still have, if we have, for instance, this right here, this is still according to the cycle. Because of how tight this range is, we expect for the push higher to sometimes get above high day. This doesn't usually happen, but in this case it did. Does that make sense? Hopefully it does. Now, into the details here of positioning. So on this move higher, we're considering this the start of, you can consider it like this too, or this is the start of a new leg. And with every new leg, you've got a new penny stock cycle that appears. All right. For you to get maximum benefit out of any of the moves, but especially the front side one, your goal is almost always going to be to position yourself as close to the highs and the lows as possible, right? If you see this big move up here, the next step in the cycle is for it to go down at some point. So you need to identify at what point is this going to go down. The most likely way for this to go down is going to be some kind of blow off, all right? In the case of highly efficient price action, something a little bit more akin to what you would see on a higher float stock or a company that isn't actually manipulating and is just trending upwards, we're expecting some kind of curl over like this at first, ignoring this part up here, and I'll explain this in a second. We're explaining some kind of curl over like this, or expecting something like this. And the reason why is because remember how I mentioned over here the idea that it's like 50-50 to continue upwards or downwards like this? It's not actually 50-50. It doesn't stay 75-25 as you go higher. You have to imagine that every time you go higher, the odds of continuing get lower and lower, right? So we have something like this. I'm gonna actually draw it out here so you can see the entire thing. Okay. So over here, we probably have like 25%, 75%. Over here, we won't have 25-75 though. It's probably going to be more like 15-85%. And the reason why is because as you go higher, more people are going to sell into the move. All right. More shorts are also going to pile on into the move. And the consequence of that in highly efficient price action regimes is that this curl over here represents turning this concept into something that is EV neutral. right? So if if as you continue higher, the odds get higher for it to go down, then that means that sellers will begin piling on into the move sooner, and you get this case where the legs will get procedurally smaller, causing this curl off. All right. Now, this is often disobeyed in small caps. And what will end up happening is after you get this curl, at some point you'll curl upwards instead. You'll curl in the opposite direction like this. And this is basically the opposite case where people are buying more as you get higher. And of course, that doesn't make any sense. This means the pricing model on the stock is irrational, and it presents the ultimate opportunity to fade the move and gain maximum benefit. Because at the very least, beyond the fact that we're high up, we also expect that anything that is above the efficiency point, which rounds off over here, all of this remaining space is illogical. So this is basically just free EV. This is the best way I think of it is anything above the curl is free EV. Now that doesn't mean that that doesn't mean like it pops, you just short right away or something. It just means that you can expect for the entire range that occurs above the efficiency area to be retraced, usually quicker than not, but sometimes these can go way more, especially considering people will start shorting the efficiency curve, and as it goes higher beyond the efficiency curve, they're going to end up having to buy in as they cover. It's kind of like it's like an unusual situation that snowballs onto itself. But ultimately, this is completely unstable price action, and it needs to end up failing at some point. So I'm looking for something like this where we extend beyond the efficiency curve to short. There's some other ways that there's some other things that can play into this that make the case even better, like a blow off top. If I can maybe give an example, did Kerr do it? Sort of. This is I guess here's another example. I guess just to quickly show you here, we get something like this curve here, and you can see how it can take a really long time for these things to really settle after they break the efficiency curve. They can go way further, and this sort of had a blow off top, not a great one. When the highest volume of the day, ideally a really high volume, is right on top, if this volume bar is like way bigger than the rest of the and then the rest of the stuff in the move, you can almost expect for it to fail immediately. It's so euphoric to the point where it has to fail. Absolutely everybody's taking bad averages, and people are going to be forced out of their positions with a mass exodus of stop losses for people on the long side. Now, you won't always get this much extension into the move. This is quite uncommon, but it does happen more frequently than not on small caps, and that's part of why I like it for shorting so much. But going back on over here, you can get other stuff like sometimes you'll get a harsh rejection like this, or some sort of double top idea, something that would designate that the end of the move has come or is about to come. And when you combine all these factors together, people have a whole bunch of different approaches for this. You end up getting some rationale for shorting it. And presumably, if you're correct, you get some average here at the top, and then you expect for this thing to start fading. So that's so yeah, people have a lot of proprietary ways for identifying the tops up here, and the idea is if you want to end up catching this backside move, you want to get an average as high as possible. Of course, you want to also get as close to the backside as possible, well, for your exit as well, for your cover. But when it comes to this stuff on the front side, if you are buying within the efficiency curve, anything, if you're buying anywhere within here, within this area right here, it's going to be very controlled, and it's going to be very obvious when there shouldn't be any more continuation. If you could hypothetically just buy at any point in here, and you'd be quite all right, honestly, if you had like an incredibly large stop loss and you're responsible with your stop outs. But you can't always expect for this to happen. But in small caps, it usually does. All right. And after that part, you end up on this backside area right here. This is, again, usually very controlled. It's unlikely you end up with some kind of euphoric move on the backside, because it's going to end up hitting a lot more buyers down here. Usually people who have arrived late to the move. And nowadays in small caps, with there being a heavy short involvement, shorts are going to cover into this. They're going to cover into any sort of dip. So, but ultimately the pattern continues to hold, and you'll get the range that I mentioned earlier, something like this and something like that. I guess you can even bring it over here to add this little thing in. So now, as this is going down, you don't know where the range is established here. So it's not entirely clear where you should cover here. You wouldn't see these lines in real time, but after the fact you can see how they play out, and this is usually how it'll work. Where the first one will go beyond the resistance point a little bit, and this is your distension case, kind of like how this gets overextended over here. This is considered a distension on the backside. It's just much, much more mild, and it's really all most charts can give you. And then usually we have some moves back and forth through a consolidation zone. And what'll typically happen is at some point the consolidation high will break, like it does over here. And then we get the fade. That breaks through both levels and continues on downwards. I'll cover a case where we do break higher in just a second, but I want to mention that it works the same thing where if you're trying to dip buy over here, you're trying to catch short over here, the keys for you to be able to get the good averages are, again, often proprietary, just like they are over here. However, you should not bet on outright for if this resistance breaks to the upside for us to just rotate through high a day. Most people are expecting for this resistance to break at some point and give in to the larger thesis, which says that this will be a failed breakout. That's usually how it ends up playing out. Now, for an example of something that ends up reclaiming, can look at like probably Boxel had a decent. This is okay-ish. This is I guess what happens if it ends up breaking immediately. So we have an initial front side move over here. Some kind of proprietary way of identifying the top. In this particular case right here would probably be like a head and shoulders or a consolidation that extends for too long. We've got some move to the downside, and your consolidation zone is honestly just this little thing right here. That's really about it. So people would see possibly some kind of proprietary buy down here, and we're expecting a dead cat over here, but it doesn't end up happening. Maybe we're even expecting this little red candle to be the dead cat because we extend higher than the previous candle. But once we make a move over this red candle, now we expect to rotate because shorts are going to stop out, seeing that the original thesis isn't working anymore. And this is the idea whenever you put in a new leg, is that at some point or another, a rejection attempt is made because people are expecting for it to go down. So they end up selling here, sell, expect it to go down. But ultimately buyers are stronger for whatever reason. Maybe the PR is good. Maybe the cycle is really hot right now or something. A reclaim market, recent big runner, something that's going to make the odds higher. Maybe it could just be pure chance. Maybe it could be a manipulator. It's really hard to tell. But one way or another, if this ends up reclaiming, we end up getting the rotation through high day, which again, as a reminder, does not happen often. This is like 25% or less chance of happening. But when it happens, you can get these really, really big moves because absolutely everyone is betting on the idea of this penny stock cycle playing out. And I'm going to go back to serve real quick, and maybe we can actually see it in action over here on this model. It is probably, I mean, I'll go look at the intraday in a second, but we'd be expecting something like this where we get a move up, move down. This is our little consolidation zone. This red candle right here on July 24th shows that we make a push up, and now we're expecting for the move to continue down. This is our dead cat, our reversal to the long side. We're expecting the dead cat, but the red candle ends up getting engulfed, and that rotates us directly through high of day into the upcoming days, into another leg, and then we're expecting for the cycle to repeat itself. On the second time, it ends up working out quite all right this time. We get this distension. We get this reversal to the long side. We get back into this sort of like consolidation zone right here. We got a lot of bottoming and topping tails on the daily, except this time we put in the pin bar and we're expecting for the continuation to the downside, and that is what happens this time. Instead of us breaking this candle and rotating higher, which is, again, like I said, the less likely situation to occur here. And as a reminder, this can repeat basically indefinitely. It's crazy how frequent, it's crazy how much these can, it's crazy how many times this pattern can repeat. And this is how you end up with black swans every now and then, which is they just happen over and over and the odds aren't good, but ultimately they do happen. And sometimes you even arrive at a state where more shorts end up covering out early than shorting it down further, which results in this snowballing behavior where you really honestly accelerate the move as you continuously go higher. And as you can imagine, this is something like what's going on here. Usually we have all of these little up and down zigzags, right? The thing is with a lot of these little moves that we have is that none of these offer really, really good short setups because there isn't a lot of extension on a lot of these moves. Like a lot of them don't push way up. There's not too many shorts piling on, and an overwhelming retail interest ends up overcoming the state of the stock, and we get all these rotations higher over and over and over again. And it isn't until we get all the way up here that we finally get like a really strong leg to the upside, these expanded bigger candles. Honestly, even this isn't great, but it just happened to stop here, that we get a serious sell-off into the after hours on the specific stock on DATS. And yeah, this pattern basically repeats itself perpetually, and it's the basis for how I play almost everything.